The dark side of momentum. Of all the factors we have studied, momentum has delivered the highest returns to investors. But it has also experienced the worst crashes. The annual data reveals a significantly fat tail, or excess kurtosis, of 13.0%. Kurtosis is a statistical measure that tells us how much the returns are clustered in the tails, or the peak of a frequency distribution. A kurtosis of 3 is usually considered normal. Momentum returns also have a left skew of negative 2.5%, meaning there are fewer returns smaller than the mean, but those returns are farther from the mean than the returns greater than, or right of, the mean. The excess kurtosis and negative skew make momentum strategies prone to crashes. When a crash happens, it may erase several years' profits. Fortunately, the literature review uncovers some workable risk mitigation strategies. To begin with, long-only momentum strategies are less likely to crash. In the 2009 reversal, for example, low-momentum stocks produced the largest gains. Such crashes are much more likely to affect long/short momentum strategies, however. The risk of momentum is highly time variable and quite predictable, as Pedro Barroso and Pedro Santa Clara discovered. They found that while predicting the returns was difficult, volatility was more predictable, as this month's volatility provides information about next month's. This makes volatility an important risk measurement metric that can significantly reduce the impact of crashes in long/short momentum strategies. The authors also found investors can mitigate the risk by varying exposure to momentum over time. Further, risk-managed momentum strategies achieve a higher cumulative return with lesser risk. For example, a momentum strategy can scale exposure to momentum by using the realized variance of the daily returns in the last 6 months, a measure of volatility. An investor using a risk-adjusted long/short momentum strategy that targets a specific level of volatility would invest less when the markets are more volatile and vice versa. Besides reducing the chances of large setbacks, such a strategy can also help improve investor discipline by reducing the chances of panic selling by distressed investors. An alternative risk mitigation approach involves removing the return component due to market beta. Dennis B. Chaves adopted this approach. He used regression to remove the impact of market beta and provided a new risk-adjusted definition of momentum. Lastly, factor diversification is a good way to mitigate the risk of momentum crashes. For example, value and momentum are negatively correlated, so combining the two can reduce the overall risk of a portfolio.